All right, let's jump right in. Today, we're going to break down a huge financial puzzle that thousands of homeowners are dealing with, especially if you're in a place like Colorado. We're calling it the Class-4 roof math. And really, it all boils down to one single, kind of scary question.
I mean, that's a tough question, right? For most of us, a surprise $20,000 bill is something that feels, well, completely out of reach. But what if I told you the real question is, can you afford not to get one? You see, if you live anywhere in Hale Alley, think Denver, Colorado Springs, you know exactly what I'm talking about. These massive storms aren't a surprise anymore. They're just a fact of life. And the insurance companies, they've definitely noticed. They're pushing homeowners to upgrade to these super tough, impact-resistant roofs or face the real risk of losing their coverage entirely. So, what do you do if you don't have 20 grand just sitting in the bank? Well, so a lot of people, the answer is actually locked up in the value of their own home. That brings us to financing the fix. And the key here is finding the smartest, most efficient way to borrow that money.
Okay, so the tool we're really going to zoom in on here is a HELOC. That stands for Home Equity Line of Credit. The easiest way to think about it is like a credit card, but it's secured by your house. This gives you access to cash when you need it, but, and this is the important part, it almost always comes with a way lower interest rate than other kinds of loans. And yeah, this slide really tells the whole story. You can see right here, looking at recent data, the average HELOC is sitting around 8%. Now compare that to a personal loan at 12% or a credit card that can easily shoot past 20%. When you're borrowing a big chunk of money, like $20,000, that difference in interest is it's absolutely huge. All right, so now we get to the fun part, the real reason we're here, the napkin math. We're going to break down, step by step, how financing a $20,000 Class-4 roof actually shakes out on a monthly basis. And I think the final number is going to surprise you. Okay, so based on those HELOC rates we just saw, borrowing $20,000 works out to a payment of roughly $150 a month. Now, I know what you're thinking. That's the cost. That's the new bill you have to pay. But hold on, because that is not the end of the story. Not even close. This is the pivot. This is what most people miss. A Class-4 roof isn't just another expense. It's an investment that insurance companies actually reward you for. By the way, Class-4 is just a fancy rating that means the shingles can withstand hail up to 2 inches thick. Because these roofs are so much tougher, insurers see you as way less of a risk, and they pass that savings right back to you. So just how big of a discount are we talking about here? Well, depending on your policy, homeowners with Class-4 roofs can see their premiums drop by anywhere from 10 to 35%. For a typical homeowner in Colorado, that can easily mean saving $1,200 a year. Or, to put it another way, about $100 back in your pocket every single month. So let's look at those two numbers side by side. You've got the new $150 payment for the loan, but you've also got this brand new $100 savings on your insurance. That discount immediately wipes out 2/3 of your new payment right from day one. So, if we take that initial cost and then we subtract that big new savings, what are we actually left with? What's the real, true out-of-pocket number for this massive upgrade? $50. That's the number. The net cost to get a top-of-the-line, insurance-approved roof that protects your biggest asset could be as little as $50 a month. We just took that terrifying $20,000 number and turned it into something you might not even notice in your monthly budget. But wait, it actually gets even better. The financial win doesn't just stop at that premium discount. That's just the most obvious one. There are a bunch of other ways this investment starts paying you back, almost like stacking up benefits on top of each other. So let's look at how these benefits stack up. First, because you're using the HELOC to substantially improve your home, the IRS says that interest you're paying is very likely tax deductible. Second, a new roof in a market like Denver adds about 65 to 70% of its cost right back to your home's value. And finally, you get to avoid those heart-stopping hail deductibles, which can be thousands and thousands of dollars out of pocket after every single big storm. Okay, so let's flip the coin. We've talked about the cost of acting, but what's the cost of doing nothing? Well, the high cost of waiting is all tied up in how your insurance policy is probably going to change if you stick with that old, vulnerable roof. To really get the risk here, you've got to understand these two acronyms. RCV, or replacement cost value, is the good one. That's what you want. It means if your roof is destroyed, they pay to make you whole again. But more and more, insurers are shifting people with older roofs to ACV, or actual cash value. This policy only pays you what your 15-year-old roof is worth today. It's like totaling a 15-year-old car, and the insurance company sends you a check for a couple $1,000. it's not nearly enough to buy a new one.
And this table just lays it all out, plain and simple. Path A, with the new roof, you have a totally manageable net payment, and when the next storm hits, you're covered. Path B, you do nothing, you're stuck paying high premiums, and after that next big hailstorm, you could be looking at a bill for $15,000, maybe even $20,000 out of your own pocket. That's the difference between what your old roof was worth and what a new one actually costs. So really, it's time we start reframing this whole conversation. We need to stop thinking about a new roof as just another painful expense. We need to start seeing it for what it is, a proactive investment in your home security and your own financial well-being.
You know, this quote just nails it. It really gets to the core of it. Most people think they can't afford a Class 4 roof, but when you actually do the math, you realize you're already paying for it. That money is leaving your wallet one way or another, either through bloated insurance premiums and taking a huge financial risk, or through a small, controlled payment that actually builds value and protects your home.
Of course, everyone's situation is a little different. Your home's value, your current premium, how much equity you have. That's why we put a tool on our website called the Colorado Equity to Premium Analyzer. It lets you plug in your own numbers so you can see exactly how this math works for you. So at the end of the day, that's the question you have to ask yourself. Is your roof just a passive expense that you let the weather and the insurance companies dictate? Or is it a financial asset that you can actually control, one that saves you money and protects your biggest investment? Thanks so much for tuning in.